The live trading price for SoFi Technologies Inc., ticker SOFI, sits right now at $29.07, reflecting an intraday move of down $0.44, or a decline of approximately 1.5%. Many investors are currently fixated on this slight dip, wondering if the recent parabolic run has finally hit a ceiling, especially after the stock nearly doubled over the past 6 months, approaching its 52-week high of $32.73. However, the unexpected reality that the market is still processing isn't the price action itself, but the nature of the volume behind it. Today's pullback is occurring on volume notably lower than the 30-day average. For a stock like SoFi, which has a massive retail following, a low-volume decline often suggests an absence of conviction selling from the core shareholder base, meaning the selling pressure is likely coming from short-term traders taking profits, rather than a fundamental change in the long-term institutional thesis. This low-conviction pullback is actually a healthy sign of consolidation, not a warning of a major reversal, which should reframe the immediate market narrative for anyone looking at this stock. The general market expectation for SoFi has shifted dramatically over the past year. It's no longer viewed simply as a student loan refinancing player. The common belief now is that it's a digital bank with a robust technology stack primarily valued for its transition to consistent profitability and its bank charter. People expected it to eventually turn a profit, but the velocity and scale of its achievement of GAAP net income for 8 consecutive quarters, culminating in the record $139 million in Q3 2025, significantly exceeded those expectations. The prevailing narrative is that the flywheel model, acquiring members through financial services like checking and savings, and then cross-selling them into higher-margin loan products and the Galileo technology platform, is working. What this common view misses, and what the deeper analysis reveals, is the quiet, structural pivot underneath the hood. The reality is that SoFi is actively de-risking its model by dramatically increasing its capital-light, fee-based revenue. The third-quarter fee-based revenue hitting a record $409 million, now accounting for 43% of adjusted net revenue, is the real story. This is a deliberate architectural change, making the company less susceptible to interest rate volatility and credit cycle risk, the very things that plague traditional banks. The market is still pricing SoFi with a legacy fintech risk discount, but the fundamentals are pointing towards a more durable, diversified financial powerhouse. The recent launch of SoFi Crypto, becoming the first nationally chartered, FDIC-insured bank to offer consumer crypto trading, is another layer to this fee-based revenue structure that the Street has not fully appreciated in its long-term models. This move brings crypto under the regulatory umbrella of a bank, which is a massive competitive differentiator and a high-margin product kicker, rather than just another side project. The daily trading activity confirms this tension. Despite the stock's immense run-up this year, up over 80%, the intraday movements remain volatile, typical for a name with high retail interest and a large outstanding float. Institutional activity, as evidenced by recent 13F filings, shows a significant increase in ownership. Funds like Vanguard Group and BlackRock Inc. have been steadily accumulating shares, while a firm like JP Morgan Chase & Company had a massive increase in its stake, signaling strong institutional buy-in on the long-term profitability story. However, this accumulation is countered by active trading in the options market, which generates that daily price swing. The large open interest in out-of-the-money call options suggests that many retail traders are betting on a continuation of the upward momentum, looking for the next catalyst to push the stock into the $35 to $40 range. The slight downward pressure we see today is likely a combination of these options expiring or rolling over, combined with a natural reaction to profit-taking after a huge rally. Now, let's address the short-selling dynamics, which is a critical piece of the puzzle for a stock with such a passionate investor base. SoFi is and has been a target for short sellers. The current short interest stands at a notable 116.12 million shares, representing a short interest percent of float around 9.80%. While this figure is significant, it's actually lower than peak short interest seen earlier in the year, which is an important detail. The days to cover ratio is relatively low, around 2.58 days, indicating that it would not take an excessively long time for shorts to cover their positions, thus mitigating the immediate risk of a massive short squeeze. The borrow fee rates have been surprisingly low, lingering around 0.25%, which is a key piece of actionable insight. A low borrow rate means short sellers are not paying a punitive cost to hold their bearish positions, and the lending supply of shares is ample. This suggests that the large institutional short positions, while present, are not stressed or squeezed yet. Notable short interest is often held by large sophisticated macro funds who view SoFi's lending business as exposed to an eventual recession or credit tightening, arguing the personal loan segment is overextended. Their thesis is a classic credit quality play, that the impressive loan growth is masking future delinquencies that will eventually crater the bank's balance sheet. For the retail investor, the low borrow rate is an important signal to monitor. A sudden, sustained spike in the borrow cost, along with rising failed-to-deliver data, would be the genuine signal of a short squeeze setup. Right now, the low cost means the short side is comfortable, and a short squeeze based purely on borrow scarcity is not imminent. Actionable advice for investors here is to check the days to cover on a weekly basis and look for a move above 5 days, which would signal meaningful pressure. Investors should also be cautious about coordinated hype on forums like Reddit that might call for an immediate squeeze. Without a rising borrow rate, those attempts are typically absorbed by the market's liquidity. Do you think the government will pass legislation in favor of the cannabis industry anytime soon? Comment below how many shares of SoFi Technologies Inc. you currently hold, or if you prefer the old-school banks. This type of engagement with the community helps keep the conversation grounded in real conviction. SoFi's underlying business is all about that integrated ecosystem. They offer lending products, personal loans, student loan refinancing, home loans, along with the SoFi Bank, which provides deposit accounts, and a technology platform called Galileo, which powers other fintech companies with their core infrastructure. This vertically integrated model is the core of their structural advantage. They acquired a bank charter, which allows them to fund their loans with cheap, sticky member deposits, rather than more expensive wholesale funding. This banking strategy is what drives the current narrative of financial independence and a one-stop shop approach for its members. The most recent Q3 2025 report solidified this, showing total members at 12.6 million and total products at 18.6 million, clear evidence that the cross-sell engine is running efficiently. Looking ahead, the future outlook for SoFi is intrinsically tied to two main factors: the trajectory of interest rates and the continued success of the Galileo platform. On the macro side, a potential slowdown in the pace of rate hikes or even future cuts is a significant tailwind. Lower rates would reduce their funding costs even further and stimulate demand for their high-margin lending products, particularly student loan refinancing. This is the expectation. The reality catalyst that is less discussed is the increasing contribution from the technology platform.
While lending grabbed the headlines for profitability, Galileo's growth in both revenue and clients outside of SoFi is the real long-term engine for high multiple valuation. It's a B2B business that allows SoFi to essentially sell its core competency, its digital bank infrastructure, to its competitors. Growth in this segment is pure software-as-a-service revenue that institutional investors value at a premium, compared to traditional banking assets. Risks include a sharp economic downturn that causes a spike in loan defaults, challenging that credit quality thesis. Another risk is intense competition from larger banks finally upgrading their digital offerings or smaller fintechs carving out niches. SoFi has addressed this by maintaining excellent credit performance metrics even during periods of economic uncertainty, with personal loan delinquencies and net charge-offs consistently decreasing. The expectation remains that SoFi is a fast-growing but still relatively new bank. The reality is that the management team is systematic